All right, think about this for a second. Even if the Federal Reserve had begun raising interest rates 9 months earlier than it did, U.S. inflation, it actually wouldn't be any lower today than it is now. That's according to a new model from Bloomberg Economics. Let's go back in time here, because the general consensus, at least in the markets, is that the Fed started the rate hiking cycle way too late.
You know, with the benefit of hindsight, I'm sure that people at the Fed would have loved to have moved earlier. It turns out, though, that the Fed's forecast actually stacks up rather well with the consensus view. The Fed was not better than, but also they weren't worse than the consensus. We looked at 39 forecasts that were submitted to Bloomberg Economics. Every single one of them was too optimistic about where inflation would go. The Fed was in the middle of the pack, but everybody else missed it too.
I mean, David, is there an argument to be made that, okay, even if inflation maybe would be at the same place that it is now, maybe the Fed would somehow be less behind the curve than it's found itself?
Yeah, I think there are two important points that come out of our analysis of this situation. First, earlier action probably would have shaved off the peak from inflation. So instead of a peak rate of about 8.6% CPI inflation, we would have gotten something about a percentage point less than that. So in the neighborhood of 7.5. That's not nothing, but it still isn't a game changer. We still would have had the biggest inflation surge in a generation since the 1980s. The second thing to come out of this is that unless the Fed had actually taken rates on a stronger, higher, longer trajectory than they actually pursued, we probably would be in about the same place today. They would have reaped a credibility dividend if they had moved earlier. They would have looked awfully smart. They might have saved some of the real hardship that were inflicted on American households, but we still would have had a serious inflation problem.
David, there's been a lot of folks now looking at the drop that we've seen, at least in headline inflation core, whatever you want to take. I'm just going to use headline CPI just to keep it simple. So we go from 9% plus or whatever it was down to 4% roughly now today in basically a year's time. There seems to be an argument out there made by folks in the market and even economists that a big part of that drop can't necessarily be attributed to rate tightening alone. Do you buy that?
Oh, I think there's a variety of developments that are involved there. Certainly, we've gotten some tailwind from lower energy prices, and that probably has relatively little to do with the rate hikes from the Federal Reserve. The Fed's job, though, is to control inflation without excuses. They need to take responsibility for the whole pie. They can't slice it up and say, well, we're not going to pay attention to that piece because that's not subject to the influence of higher interest rates. They have to deliver on inflation performance from the 30,000-foot level. That's why you see Chair Powell yesterday again and today this morning re-emphasizing their commitment to bringing inflation back to the 2% objective, no ifs, ands, or buts.